Hello and welcome to another video on accounting. We are continuing with our series of videos on accounting cycle. This will be the last video in that series. In this video, we are going to look at preparing closing entries and preparing post-closing trial balance. So if you have been watching our videos on accounting cycle, you will know that accounting cycle is the series of steps followed by accountant to prepare financial statements. And there are 8 steps. So in this video, we will talk about the last 2 steps, closing the accounts, also known as closing the books, and preparing post-closing trial balance. So let's look at why we close the books and how do we close the books. Closing the books or closing the accounts mean the same thing. The first question to answer is, why do we need to close the books? Now the reason is because when financial statements are prepared for a particular period, it will provide information for that period only. For example, if we prepare an income statement for 2023, it will give us the revenues and the expenses of that period, i.e. 2023 only. So when we want to prepare the same statement for the next period, which is 2024, now we need to only provide information, that is the revenue and expenses of 2024 only. So so the 2023 records, accounting records or accounting books, have to be closed so that we can capture only the next period's accounting data. So that's the reason why the books are closed. So how do we prepare for the next period? Well, we have to make closing entries. That is to close the accounts at the end of the previous period so that we can prepare for the next period. Now there are 2 types of accounts. We have temporary accounts and permanent accounts. Temporary accounts are accounts that contain the data for only one accounting period, and they are revenues and expenses and drawings. Now these contain only the data for a particular period. So for example, if we are in 2023, we are only going to record the revenues, expenses and drawings of 2023 in these accounts. For the next period, we will record the next period's revenue and expenses and drawings. Permanent accounts are accounts that are balanced and their balances go from one period to the next period. And they are assets, capital and liabilities accounts. So the accounts that we need to close are the temporary accounts. So the temporary accounts, revenue, expenses and drawings have to be closed so that they are ready for to capture the data, the accounting data for the next period only. So this is the trial balance that we have been discussing in our videos. In this trial balance, the highlighted section is the accounts that are temporary accounts, and these need to be closed. These accounts are closed via the journal entries. So just to give you an idea of how the accounts are closed, what you need to do is to look at the balance in that account. For example, in the drawings account, we have a balance of $325 on the debit side. We need to do the opposite of that so that we can close it. So since it has a debit balance, we will do the opposite, which is to credit this account in the journal entry. Now this credit entry will cancel the debit amount in this account, leaving you with a zero balance. So our ultimate aim is so that we have zeros balance in these accounts. That means do the opposite of what they are, what the balance are. So if you look at another example of legal fees revenue, we have $8,900 on the credit side. Now to close this, we will do the opposite of that, which is to debit this account. So the debit will cancel the credit amount, leaving a zero balance in the legal fees revenue account. We'll talk more about this in a minute, but just to give you an idea that we have to zero out the balances in these accounts. So let's do some closing. Now the closing process is a four-step process. The first step is we need to close the revenue accounts to income summary account. An income summary account is a special account that is kept in the journal ledger. We only use that so that we can do the closings. That is to transfer the revenue amounts into this account. Similarly, we will transfer the expense accounts to this account also, to the income summary accounts. Then the income summary account now has the revenue amounts and the expense amounts. So the difference between revenue and expense will be transferred to capital account. That means we need to close the income summary account to capital account. And finally, the drawings account will also be closed to the capital account. So we will take a look at each of them step by step. So the first step is to close the revenue accounts to income summary accounts. So if you look at the revenue account on a trial balance, we have $8,900 on the credit side. So if you remember, we need to do the opposite of what the balance is. So we need to ask ourselves two questions. One is, what is the account balance in the account I'm trying to close? It is 8,900 credit balance. So in closing entries, the second question will be to debit this account in the closing entry. Since it has a credit balance, and we will be debiting this account in the closing entry. So since this account will be debited, we need another line for a credit, and that will go to the income summary account. So the entry will look like that. On January 31st, the legal fees revenue account will be debited $8,900, and the income summary account will be credited $8,900. The debit amount in the debit line entry of 8,900 will cancel the credit balance in that account, leaving you with a zero balance in the revenue. And that revenue balance will be transferred to the income summary. Similarly, we need to close our expenses as well to income summary. That is to transfer the balances from expense accounts to the income summary account. Again, if you look at the trial balance, the expenses all have a debit balance. So we will ask ourselves two questions. First question is, what is the balances in the expense account? They are all debit. So now when we are closing them, these accounts will be credited. So each of these expense accounts will be credited. And so that is the credit side of the journal entry. The debit will go to income summary. So the entry will look like this. Income summary will be debited with the total amount of the expenses, $3,532, and each of the expense account will be credited in the journal entry. This will make sure that the credit side of the expense account will cancel the debit side of the expense account, leaving you with zero balance in that. Okay, after we have closed this thing, we need to calculate the balance in the income summary account. So the income summary account now has $8,900 credit. That is, the revenue figure has been transferred there. It has a $3,532 of a debit balance, because you can see that in the second entry, the income summary account has been debited. So it has a debit balance there. And the difference between the revenue 8,900 and the expenses 3,532 will give us a profit. Since the revenues are higher than the expenses, the difference between these two amounts is $5,368 profit, and it's a credit balance in the income summary account. So the income summary account will have to be closed as well. So to close it, we need to first determine what is the balance in that after we have transferred the revenue and expenses to income summary. So these are the four steps again. The two steps have now been done. We will look at the next two steps, which is closing the income summary account to capital account and closing the drawings account to capital account. So let's look at the income summary account. How do we close it? So we were just talking about the balance in the income summary account. So income summary account has a balance of $5,368. That is the difference between revenues and expenses, and it is profit. Profit belongs to the owner. In the owner account in the in accounting system or in the journal ledger is the capital account. So the income summary account will be close to the capital account. Since the balance is a credit balance, we will do the opposite so that to cancel the credit balance in the income summary. The opposite of credit is debit, which means we are going to debit the income summary account and credit the capital account of Mark Hayden, the owner. This will cancel the debit entry amount, or the debit line entry in the journal will cancel the balance in the income summary account, the credit balance in the income summary account. That will close out the income summary account as well. So once this is done, we are going to look at the last step of closing, which is to close the drawings account. Again, the drawing account is in the trial balance. It has a debit balance. We will ask ourselves the same two questions. What is the balance there? It's a debit balance. That means to close it, we will credit this account in the journal entry. So the entry will look like this. Capital account, Mark Hayden, will be debited because drawings are the money taken by the owner, so it has to be shifted or transferred to the capital account by debiting the capital account. And since the drawing account has a debit balance, it should be credited to close it out. So those are the two entries for the income summary account and the drawings account, and they have now been closed as well. One last thing we need to do is now we need to calculate what is the new balance in the capital account. So why? Because we transferred what was in the income summary to the capital, and the drawing account is also transferred there. So the new balance is 80,000 is already there from the trial balance. $5,368 is credited to the capital account from income summary account, and $325 is debited from the drawings account. That will leave you with a balance in the capital account as $85,043 credit balance. Okay, now that all the accounts have been closed, the trial balance that we have been following has to be changed so that we can prepare a post-closing trial balance. And this is the last step. So the first change to make in the trial balance is to change the heading. So the heading will change from adjusted trial balance to post-closing trial balance. And the highlighted section here are all the temporary accounts that we just closed. So those accounts must be now with zero balances, and any account with zero balances will have to be removed from the trial balance. So we need to cut this section out because we have closed these accounts and they should not be on our trial balance. So our post-closing trial balance will look like that without the temporary accounts. It will only have the assets, liabilities, and capital figure. We need to make two changes to the post-closing trial balance and we should be done with it. The two changes are, number one, we need to update the capital account balance because since we closed all the income summary there and the drawings account there, so we know that the new balance in the capital account is not $80,000, which is in the trial balance, but rather $85,043. So we need to change that figure of 80,000 to this. Okay, so now that we have updated that figure, the final change is to total the debit in the credit side again. So our totals will come to now $111,375 on the debit side, and the same amount will be on the credit side. So this is how our post-closing trial balance will look like. That is the final step in accounting. So once this step is done, the accountants, the year accountants' books have now been closed. So this was the video on the last two steps of accounting cycle. So if you like our videos, do click the like button and subscribe to the channel so that you can get the new videos and see the videos, and make sure that you click the notification icon to be aware of the upcoming videos. So hopefully this video was helpful, and I will see you in the next video.